Right, we're going to have to represent the team, just the two of us. Yeah. So, 360 One Firm. What is 361 Firm? The One Firm comes from Arthur Anderson. Who remembers Arthur Anderson? So we were Anderson partners. So here comes another Anderson partner. Michael. Michael was my boss. It's true, though. 1999, and we were restructuring the Russian telecom system. Talk about that later, what that means. But we rallied. We had a global team. Probably 20 countries were involved, and that's what we did, and that's what we're doing now, but in a whole different context. The incarnation of the family office world. Andreas went on to be head of M&A for Deutsche Post, and then he joined his family office, and then we reconnected. Jim, where's Jim? Jim, he's keeping the train going on time outside because he's our COO, and we've got another great team in Germany and others here. Nishant, also getting you all water. We ran out of water, and coffee cups. Thank you. Takes a village. So what we do, the 360, is what you're going to experience here at 3:30, and then again at 5:15, roundtables. We're not here to just have a panel, although we got great panelists, right, who play pickleball, right? That's another. We try to get people together so that we can. Here's Jim.
Sorry, I was cleaning up the outside.
Yes. I'm sure being super.
Volunteer environment here.
Yes. So we welcome you to the official conference. We're excited. There's a lot to do together, right? We're here to, hello, Mark. We're here to help investors invest in a more optimized way, raise capital. You want strategic capital, and you want to do it efficiently, connect to talent and partners, and then you make all this money. And I've been in the family office for 10 years. The way they approach philanthropy is not exactly optimal, and there are ways that we can collaborate on that front too. But my colleagues, before we kick it off, do you want to make a few statements, Michael or Andres? If I give it the microphone to him, he's going to crack a joke, but it's okay.
I'm not doing a joke. I'm happy that you are here. We are kicking off now a different set of events. Today it's the first time that we do that, having the core group in the morning, having then PCI session and this session later on. We do this now in next year in a more heavier cadence all over the world. So next week, Mark and I am going to Singapore. We like to connect people, and this is for us important, that we try to bring over ideas from one side of the world to the other side of the world. We have a great community also in Singapore. We'll meet some of the investors we are close by to, and what we try to do is share ideas, collaborate together, and create a great network. And this is what I like to give you with, and saying, have fun, work together, talk to each other, and see what we can do together. This was the thing which made us successful when we started in Arthur Anderson. We collaborated also worldwide with others, and this is something where we believe will ever last over the years and years in the world. Thank you.
Yeah, also warm welcome from my side. Everything has already been nicely praised here by Mark and Michael. Maybe just adding to that, what I like and appreciate here is indeed also the diversity that this group represents from a regional perspective and backgrounds and experiences. And this is what we try here to leverage and to transfer that to the investment world, because we are strong believer that you only can create really additional return based, at least that's also my conviction, if you put some hard work into something. Not necessarily that, I think it was a 20,000 hour rule or whatever that was, but having a sense of what you're doing and why you're doing it, and also having the persistence to hold on to that's something I think is valuable. And having a group of people who live those values, and let alone other values, which I think also very important. We touched upon that at the dinner yesterday. And I think it's also a very important aspect that it's really a group of like-minded people and driven by the same values, and that should hopefully not only be to make as much money as possible, but also other things.
What comes around goes around.
Mine would be very brief, and I would just reflect on the 6th New York Global Conference, and the flagship events that we do in New York are really the best of 361 firm, because we bring together, as everybody has mentioned already, so many people, so many friends with common interests. And, you know, it's really a kind of the cultural paradigm of what we do. We do other things as well, obviously, through the investment lens, but just the act of getting together is really important to us as the partners of 361. We hope you agree, and it's always good to be with you here in New York on what we consider to be our home turf. So welcome.
So with that, I'm going to hand off to Mary D'Souza, who's with her own family office. She moderated this panel last year, and she did a good enough job. She's back. Over to you.
Thanks, Mark, for having me back. Good afternoon, everyone. I'm so happy to see this room full. You guys are going to have a treat. I have some really impressive people over here, and we're going to talk about public markets. We're going to talk about global allocations and emerging markets. My name is Mary D'Souza. I'm the CIO of Misha Investments, a single-family office. I'm a senior advisor at Star Mountain Capital, and on the board of Southern Ag, a trucking company. These nice little Southern boys gave me a board seat. And two nonprofits. One is Community Access, and the other one is Working Nation. With that, I'll turn it over to the panelists, and they'll introduce themselves.
Thank you very much, Mary. I have not been to this particular version of 361 before, but I have known Mark for definitely over 20 years, so I guess I qualify as an old-timer. Anyway, very nice to see everybody. Thanks for having me. My name's Roberta Brzezinski, and I'm an emerging markets private equity investor, currently involved in both private and public equities. And what we said we were going to do is talk a little bit about our investment philosophy. So what I do is I run a vertical that looks at kind of transparent, good, well-run, and growing and cash flow positive emerging markets originating companies that we believe could make good public market candidates in a developed market exchange, whether the U.S., probably just the U.S., because all the other exchanges are kind of crappy right now. So we are kind of out trolling the world for interesting companies. And why do we do this, and why do I do what I do? I've been doing some version of this for over 20 years. Because we believe that emerging markets, and I know there's a lot of people in this room that have some background in emerging markets, or they're personally from an emerging market. You know, emerging markets have been kind of starved of access to capital for a long time, really since the global financial crisis, with the possible exception of China for a period of time. Let's leave that aside. It's kind of come and gone. But, you know, because U.S. Financial engineering and the private equity space looked so compelling to institutional investors, you know, people stopped looking at these markets. There's some great companies run by great people that deserve our capital, and that's my investment philosophy.
And you beamed in Poland.
I did.
Which was great, because we're also looking at Eastern Europe again.
Yeah. We need to talk about that today, so are we.
That was great. I know I met some of you at the conference in Naples, so thanks, Mark, for inviting me back.
You did a good enough job last time.
Exactly. I know last time you also mentioned that, I don't know, I opened the eyes of people on how we use AI.
And Patricia, we need Patricia, AI Fund.
Oh, great.
She talked about what you're doing.
Awesome. So hopefully this time I'll talk about something else that's different and new. And so for those I haven't met before, my name is Dee Sharma. I work at a little-known firm called BlackRock, but I work in a little-known part of BlackRock, which is as an LP within an asset manager. So I'm in our outsourced CIO business. And what that really means is we act as the investment team on behalf of what used to be largely focused on defined benefit pensions, but over the last 5-6 years has expanded to include family offices, endowment and foundations. We work with over 150 institutions globally. So I'm in a global role. My focus is on manager selection. So we look for, the best managers and best opportunities, regardless of where you are on behalf of the institutions that we work with. And I think in terms of investment philosophy, so I'll start out right by saying, since we are recording this, these are my views, these are not my firm's views, please don't attribute me or get me in trouble. But my investment philosophy has really been focused on, how do we invest in the new regime versus kind of the period of great moderation. So there's a lot that we are evaluating when it comes to asset allocation that we'll talk about, evaluating in terms of how we even select managers, where there are sources of beta in private markets, which I think is where a lot of people are allocated versus what are going to be the new sources of alpha. How do you make sure that you're not over-diversified when you're going out and looking at, number of deals? So those are kind of some of the topics that I'm really focused on, defining and designing portfolios that include a lot of GPs where you can actually show your conviction and have a few good deals. So in the words of kind of the Berkshire Hathaway luminary, I've been reading all the quotes. Simplicity is key. So keep it simple. That's my investment philosophy, and that's how you really get to a good outcome.
Thank you. Stephen Burke, I'm new to the 361 community. I'd like to thank you for letting me speak today, Mark. Our philosophy at ARS, but before I start, if I say anything that's right, that's ARS's house view. If it's wrong, it's mine. That's our internal policy for this. And our philosophy at ARS of investing is we try and buy the most assets, earnings, and cash flow for the fewest dollars in the companies are going to be the beneficiaries of global capital flows. So we're really trying to pick the winners, the industries that are going to win, and find the undervalued businesses that are going to get supported by the global tailwinds. We're investors, not traders, so we're looking out really from a thematic perspective, we're looking out for the next 2 to 3 years. From a security perspective, we're really looking out 12 to 18 months. So it's a bit of a different approach, and that takes us away from where the most managers are. And as Dee would say, 90% of the managers she sees all have the exact same portfolio, and you really want to be investing in the 10% that aren't, and that's where we're focused.
Thank you, Stephen. So I'll start from the globe and then move. So I'll start with you, Deepika, because you do global allocations. So maybe you can touch a little bit on the state of that, and also talk about what you learned from 2023. And we are at year end, and so you're probably deciding what you want to allocate in for 2024. So we look forward to I think it'll be really interesting for all of us, especially for us because we do public as well as private. So we can learn a lot from you.
So yeah, I mean, the last few weeks have been interesting because all our GPs and banks that we follow have been publishing their outlooks. So I've basically been spending my time reading all the outlooks. And I think one of the things that I found particularly interesting is, around this time last year and even in June, there was so much fear in the markets. So we were, there was still a high probability of recession. If you look at Bloomberg right now, it's still at 54%, although the bank views have come out to be much lower. We were still a lot more worried about inflation and rate hikes. I think what we are focused on right now, and what I think about is, when I look at these outlooks, is what are people telling me that is a structural change, and what are people telling me that's a cyclical change? And I think a lot of what is cyclical is really a matter of what's been unwound as part of the supply shocks, or kind of the response of consumers to what's happening in the markets. I mean, the housing market is frozen. That's going to change, but a lot of that is cyclical. Versus when we think about long-term investing, what do you structurally expect? Slower global growth, structurally stickier inflation, even though that may come down, and then structurally higher rates. And then how do you create your portfolio to be in line with that? And I think, one of the kind of areas that's been well talked about is the traditional way of allocating is no longer going to work. So we have been updating a lot of what we think about, especially when it comes to kind of that higher for longer. So like the way, I found this term, which was like higher resting heart rate of the economy, and for inflation relative to prior years. So you're going to have to account for that. And something that we are changing is distinguishing between the beta opportunities, so those 90% of the managers versus the alpha opportunities, and specifically in private markets. So we did a study where we looked at, like the one of the indices, best indices for private market GPs is the Cambridge U.S. Private Equity Index. If you look at its excess returns versus Russell 3000, there's like last 1, 3, 5 years declining outperformance from the traditional PE. A lot of the PE outperformance came from multiples expansion, so we are really focused on value creation, more idiosyncratic investments, looking at opportunistic direct co-investing, for a larger portion of the portfolio. The advantage of that is you do, like we calculated on a 100 million portfolio, if you do 20% co-invest, you're saving close to $3.5 million in fees and carried interest over the lifetime of your investment. So, there are ways, especially with the fundraising environment where it is, to really think about, be smarter, like access to secondaries that are trading at 20% discount, rather than doing primary deals. So that's where a lot of our time is focused. And then another piece I'll mention is, the importance of dynamism. So we had, at least at BlackRock, our own Outlook meeting. That was a 2-day meeting. And then one of the things that was presented is kind of the importance of rebalancing more frequently. So this is across public markets where, if you did rebalance more frequently in the last 15 years prior to 2000, it actually didn't matter. Your, no rebalance portfolio versus semi-annual versus annual rebalance portfolio gave the same return over a long period of time. That has actually changed in the last 3 years. So, and we did a survey of 120 single-family offices that we published recently, and one of the findings was that that's across the board, that family offices are reviewing portfolios and positions more frequently. 76% responded that, they are looking to change more frequently. And then there's also a matter of, going and listening to the contrarian views. So one of the reasons I'm here is also I want to hear contrarian views. And we're seeing that even in the survey, I think over 60% of the family offices responding that they were actually going out to peer networks and external partners to find and seek more input into how they were investing. So, overall, I think, what we've really learned from the mistakes is, don't just trust a single source of ideas. You need to trust multiple sources of ideas. So like these conversations and peer networks are going to become a lot more important. You need a lot more dynamism, so you can't be slow and steady wins the race. Like it really is a matter of how responsive you are to the different opportunities.
So, Steve, maybe we can touch on the public markets, and maybe you can give us a little bit of an overview on what's happening in the public markets right now and what you're afraid of in terms of the global economy. Thank you.
Thank you. So I think let's start with the global economy. We'll get to the public markets. I think the big issues come down to what happens in the U.S. and China. And to be blunt about it, Europe as well. I think when you look at the three, the U.S. is clearly the standout economy in terms of where we are. A lot of that has to do with some bad policies that we put in place, as well as some good ones. So some of the Inflation Reduction Act and some of the other things are good, solid policies put in place way too late. We did it at 5% interest rates, not at 0. So a big waste of capital, and I think that misallocation of capital that we've seen by governments is going to be one of the things that has to be unwound and we're going to be dealing with for some time. So I think that's one of the issues, and I think as the government debts are so high, it's going to crowd out essential spend, which is going to drag out a lot of the transitions we have to make to improve the global economy. So whether it's climate change or whether it's getting our grid up to snuff, all that is going to be dragged out even further because the governments are out of cash and they can't keep increasing their debt loads because of the 5% interest rate environment we're in. And in the U.S., we're closing in on, 7 or 8% of GDP is going to interest costs. It's way too high for us to move forward. So that's one of the big issues. I'm really worried about Europe and how that program, how the European Union manages its way through the current challenges that they have, and does it hold? That is a concern of mine as you see the elections that have come out lately. So that would be one. And I think lastly, obviously we're worried about the wars. It feels like None of the countries really want to take it to the next level, particularly China, Iran, and the U.S. So that dialing down and calming down some of those issues, I think, is going to be one of the things that will drive a lot of investment strategies going forward. The one fear I have with that is around that you're going to see countries like China and Russia playing the waiting game to see how the U.S. election plays out, if they can, and how things evolve in Europe, because the longer it goes on for Russia, the less likely the support stays, and that's a big problem for the world, in my view. I think what's going on in the Middle East is actually seems to be right now stabilizing, which, if it stays contained, I think that allows us to move forward. And right after the war broke out, there was an event in New York, and I saw Todd, and I said to Todd, Rupert, what do you think about this? And he said, I'm not doing anything different. And we talked about it. We decided, don't do anything different, but think about the world differently. And I think that's how you have to view the risk level on that. So I think those are the things we're worried about. And then the last thing is unemployment, which has been very low around the world. And it's been one of the surprises. And I think when Mark Lopresti was raising how come the consumer's been so strong, I think there's two reasons for it. One is unemployment is at ridiculously low levels, and that can move pretty quickly the other way, and we're starting to see that with layoff announcements. So that's one of the things to keep an eye on. I think the other one is you have the baby boomers retiring with massive wealth, 70 trillion or more, and they're not slowing down their spending because they don't have to right now. So I think that's the put and take on the consumer right now that we have to keep an eye on. So that's where we'd say from the global side. In the public markets, we see a number of opportunities, but not in the things that everyone's focused on. Obviously, the FANGs you need to have if you're in the public markets to even stay in the game, if you're not well represented in the FANGs. But we see big opportunities in the industrial metals area, in the things that are going to drive the infrastructure build out, the reindustrialization of the global economy. Those are the big themes that we see you can play out and will play out for a couple of years. And even though some of them haven't worked, like the industrial metals, copper, and the like have come in a lot, that's more due to China reopening than the demand story. So I think if you're looking at your toes, you're going to get in a lot of trouble. If you look down the road, you're going to be a lot better off in investing.
And just to add to that, right? If you look at all the stocks, all the quality stocks are all hitting an all-time high. So if you had stayed out of the market and you decided at some point you're going to get in, there's no time to get in right now, right? I just wanted you guys to quickly touch on that, and then I'm going to hand it over to Roberta.
I think the numbers show timing's exceptionally hard. So I think you keep your core positions as core, and you trade around the fringes, and you take what the market gives you in this environment. So we had big moves this year up in the FANGs. This is the time to start paring back some of those exposures, but not giving up your core position, and then take what the market gives you on the downside too. You had things pulling back massively, and one-day moves of 25% on mega cap stocks is really unusual. So you got to take what the market's giving you there. So I think it's a balance, is how I'd focus it.
Yeah, and I'll add the new term Mag 7. So, I mean, I've looked at a lot of studies around concentration versus diversification. It happens in cycles. So there have been cycles, like when you look at the entire history of the stock market where, I mean, and it was a while back, like, when markets got this concentrated, but it always comes back. So, I mean, if I look at, and I think the other flip side of the argument is we were kind of having the same conversation 6 months ago where we said, these valuations for NVIDIA don't really make sense. But I think a big part of it is like, if we continue to believe in disinflation, if we continue to believe that there will be rate cuts next year, that is going to be positive for equities.
Innovation, right? Yeah. I mean, NVIDIA's where it is because of innovation. Keep constantly innovating.
Yeah, I mean, my view is that other players are seeing that, and they're already coming to market, and it's really about like how wide is their economic moat. But you're right, that's definitely part of it.
Thank you. So that was really interesting. Deepika, thank you, and Steve, thank you. And we don't touch on emerging markets often enough. So this is going to be really interesting and delightful to hear from you in terms of what you guys are doing in emerging markets, and is it a good time to get into emerging markets?
People don't hear enough about emerging markets because no one really gives a crap about emerging markets. Let's be real. But so the question is, what can emerging markets do for us here in the United States? That really has to be the question. So I myself spent a career, living and or working in all the key regional markets around the world. But now I'm here. I run a NASDAQ-listed SPAC. I'm here. I'm in the U.S. public markets. And the question is, again, what do emerging markets have to offer U.S. investors? It doesn't have to just be U.S. It could be any developed market investors, any ultra high net worth investors, everybody who can pick and choose between assets, right? So, and I think to answer that question, we also sort of need to answer the question: do we have an economy of hope, or do we have an economy of fear right now?
Bill certainly should.
And Roberta, you're doing God's good work.
So, one of the other things I learned a lot about the last couple of years are SPACs, which probably nobody wants to talk about here, but it's actually a really interesting question because, when you had a kind of a sustained bull market and you've got a lot of companies that are, essentially many of them PowerPoint companies, but in really important, cool sectors like EV, mobility, like anything to do with climate, like all kinds of different stuff like fintech, financial inclusion, really impactful themes, then these companies were primarily starting to come to the market through these public structures. So kind of almost skipping some VC or having some early VC and then going right to the public markets. But the public markets, having been affected by all these other themes, meant that the IPO market, as I'm sure everybody in this room is aware, essentially has been shut for about 15, 18 months.
What are the markets that you find the most exciting? What are you most
This is the only market that's exciting. Like I said, what can an emerging market company do here in the U.S.? So an emerging market company that has a globalizable business model, an emerging market company that came up with a great technology, like Kaspersky, whatever. There's plenty of these examples where, brilliant emerging market scientists, if you will, or entrepreneurs who came up with a business model or service or product which can work around the world. We've been looking at a bunch of different climate related companies, but in any case, that needs to work here. These need to be companies that are offering something that people want in the developed world, because the developed world is the dog, and emerging markets, if you will, are the tail when it comes to new product development. So that's what we do. We're kind of showing the two things, look at the two things together, emerging markets and developed markets. And to do that, you really have to look at what's happening in the stock market today, which things have to change in 2024, and I think they will.
Thanks, Roberta. I just wanted to quickly touch, Deepika, I think a lot of people in this room want to hear how you evaluate managers.
And are you still using ChatGPT?
Was never using ChatGPT. There's more to AI than ChatGPT. So I'll just stop there, and we'll have a conversation later. But so I think I think Stephen said it really well, which is the 10%. That's what we look for. So look for differentiation. You look for persistence, and the strategy and the theme. Like, why is it going to last? Why is it going to deliver alpha? Because we have limited time. Like, I'll give an example where your asset allocation can actually not serve you well. We did a study recently of the endowment model 1.0. David Swenson, rest in peace. But we looked at kind of how the endowments that are covered in the Nakubo survey have done over the years. One thing we found is that size really matters. So larger endowments that have the expertise, right teams that are able to go and negotiate better are more well suited. They're getting ideas from a lot of different places. I think the second thing we found is a lot of the endowments actually invest 40 to 50% in private markets. There were a lot of managers, 10 to 20 managers, underlying 100 plus deals. When we compared that in terms of exposure to economic growth and inflation, the portfolio was no better than a 60-40. So, making sure you understand where economic exposures are coming from is really, really important. So we look for that when selecting GP. So it's not just about, are you the best in what you do, but it's also about how do you fit in a portfolio, because for you to get in, something else has to get out, so it's always a relative conversation.
Thank you, Speaker. And just want Stephen to quickly touch on what you're investing in right now. What are you finding most attractive?
So we've stayed with the energy theme. We like both the fossil fuel and the renewable side, although the renewable side we're out of right now because the valuations, we made our money and took off before they started dropping. We like the defense industry. national security is not going to get any less of a problem in our view. So the top 5 U.S. defense companies you can buy, they have a total market cap of less than $750 billion. And they are arguably the 5 most important, or 5 of the 7 most important defense companies in the world. We like the industrial metals, steel in the U.S. We have a massive infrastructure rebuild that's going to continue to go on for the next decade that the government's backing, so you can make a lot of money in that area. And the industrial metals that are essential for all these transitions that we're trying to do are down a lot this year, but they're in way out of whack on the supply-demand dynamics going forward. So those are the areas that we're really focused on. Obviously, you need to be in the tech space, but tech to us is getting more about not tech for tech's sake, but how companies are using tech to improve productivity, and that's really what we're focused on with tech.
So it could be industrials, right?
Yeah, oh yeah. A lot of the industrial companies at Parker Hannifin, Eaton, those companies are big on the electrification that's going on too. So those are the themes.
Thanks, Steve. Roberta, any last-minute thoughts or remarks from you on the emerging markets?
Well, maybe not in emerging markets, but just generally, I give you a shout out for looking at manager selection. I would just remind all manager selectors that having innovation in a private equity portfolio is so hard to do. But the smart money and endowments and foundations does go out and find kind of those new managers and new managers I asked the question really for you. New managers versus kind of old line managers. You guys are researching that. What the returns look like. Just curious, actually, taking an opportunity to ask a question.
She'll touch base with you later on. But thanks, panelists. You've been amazing. Thank you, Mark, and thanks, everybody.
Telling Topeka we play ping pong later, maybe, but not. All right, if you're pictured here on the asset class, I'm gonna welcome up. In particular, Todd's gonna kick off with some slides, and then David, you're gonna moderate. That's right. But just give me a second. I want to bring out Todd's slides. Actually, you can take.
Okay, so Mark asked me to talk about the venture marketplace. I'm going to give you some macro information about what's happening in the venture marketplace. Then I'm going to talk about why it's a very attractive time to invest in early stage venture.
Can you hear me? So I'm going to talk about the macro environment for venture, then two other areas. One, why we all know about the power law of venture capital, but there's also a power law in vintages of venture capital. So I'm going to talk about why it's attractive to invest in venture capital, primarily early stage venture capital, in a down economic environment. And then lastly, I'm going to talk about international. I don't think folks have as much allocation outside of the United States. And this last panel talking about emerging markets, I'm a big buyer of emerging markets, but not in the public space, in the private space. And I'll show you some slides on that. So just to start out with, free money drove a real increase in risk appetite. So you can see here that in the last 6 years, 2017 to 2022, we had $6.6 trillion go into alternatives or private stuff. That's more than the prior 13 years combined. And it got a little bit crazy. Valuation metrics were really thrown out the window to be able to actually get deals done. And you can see that on this next page. The red lines are the number of unicorns birthed in 2021 and 2022. There were more in 2021 and in those prior 6 years. I mean, it was nuts. And still, there was quite a few in 2022, but most of those were in the early part of the year. And we're back down to a little bit more realism thus far in 2023. This takes a look at fundraising year by year, going back till 2013. But you can see the big explosion of the last couple of years. And one would be surprised to see why is fundraising still so high in 2022 when we had rising inflation, rising interest rates, market decline. And it's that high because typically a fund will take anywhere from 14 to 16 months to close. And so some of the funds that were closed in the early part of 2022 were actually in the market back in 2020. But what this chart doesn't necessarily show is the quarter by quarter change in 2023, and it was the year over year decline. But here you can see if you annualize 2023 fundraising, it's 2020. 2022 was 3x that. So we're getting back to more realistic activity. This takes a look at the money deployed or money invested into venture-backed companies. So in 2019, if you add up all of those quarters there, it's $150 billion. In 2020, it was $171 billion. And 2021 was $345 billion, more than double the prior year. And you could see the massive decline that took place subsequent to that just basically demonstrated that there was, insanity taking place in 2021. And this is a slide of what tourist investors are organizations where investing in venture capital isn't their primary business, like my prior firm, T. Rowe Price. And typically those organizations are investing mega rounds at later stage crossover investors that are looking for a company to go public in the next couple of years. Well, with the valuations down and the IPO window closed, these tourists they're tourists. They're leaving. And you can see big decline, 67% decline in terms of the dollar value of what they're investing. And I find this fascinating. So this is a combination of IPO and M&A activity, liquidity events that took place over time. And you can see in 2020 and 2021, there was over $1.1 trillion worth of distributions. So 2021 was $768 billion. In 2022, it was $73 billion. Now you saw an increase a little bit in the third quarter of this year. The big names that IPO'd were Arm and Instacart, Klaviyo, Birkenstock. But by and large, I don't think that the window is going to really open until we have better clarity on interest rates, on inflation, and that there's more of a meeting of the minds between buyers and sellers. And this looks at the increase in venture-backed bankruptcies that have taken place. So in 2022, through the third quarter, there were 235. In 2023, through the third quarter, there was 459. That's a 95% increase. And most of these are later stage companies that just didn't make it. It's not looking so much the earlier stage. And you can see the absolute ridiculousness where valuations got. This is economic value to the next 12 months revenue multiple. On the left-hand side is high-growth SaaS companies, and on the right-hand side is high-growth consumer and internet companies. And you can see, this is very, very healthy. Back down to reality. And as we saw on that prior page, that public market declines in valuations has shifted over into the private market. But most of the private market, it's the later stage companies that took the biggest hits. Series D from a $710 million valuation back in the fourth quarter of 2021 down to $347 million. But you can see on the early stage is insulated and resilient. Now, some of that increase there is attributable to the hype around AI, but for the most part, the early stage is more protected. So what does all this mean? So mega rounds have dried up. That's the tourist investors, $100 million plus rounds. They're gone. Portfolio companies have shifted from growth at all costs mentality, so that the era of blitz scaling the top line revenue without regard for what's the quality of that top line, that's over. There's more focus, as should be, on unit economics and profitability. A lot of actions taken to extend the cash runway. this money that was raised in the last couple of years is not being spent. So many of the venture capitalists are focusing, most of the venture capitalists are focusing on their time with the existing portfolio companies, providing some financing for them. So it's money's not being spent. You're seeing a lot of down rounds. Secondary activity is great, providing some liquidity. But all of this activity is leading up to the point where we might have a very attractive power law vintage over the next couple of years. And the area that should do the best is early stage. So let me now talk to investing in a down market. So the red line here is the average U.S. venture capital upper quartile total value to paid in. And the black is the dollar adjusted average S&P public market equivalent of that. So you can see in 1998, on the left-hand side, from 1998 to 1992, venture significantly, venture outperformed the public markets, but not by a ton. But then you look at the number of years from 1993 to 1996 that followed the recession, massive increase in the returns of those vintages in the venture space. Same thing in the early 2000s. Venture outperformed the public markets, but not by a lot. But then after the great financial crisis, you had a pretty significant increase and across the board. Yep. Oh, you told me, okay. Okay. These are companies that were founded during a period of economic downturn. I mean, I could add Microsoft to that list as well. Okay, venture investing outside the United States, real quickly. Left-hand chart, the left-hand side of that is the number of countries, number of cities around the globe that had at least one unicorn. Back in 2013, there were 38, 18 in the United States and 20 outside the United States. Fast forward to the end of 2022, there's 168. The 116 of those are outside the United States. So the United States grew about 2x, outside the United States 5x. This takes a look at unicorns, maybe look at the right-hand column there in terms of valuation and all. There's pretty equal between outside the United States and inside the United States. And we all are familiar with the PayPal mafia, individuals that worked at PayPal that ended up spinning off and starting other companies. That's happening all over the globe. Rappia's in Latin America. This is out in Southeast Asia, also out in Southeast Asia. This is in the Middle East, here in Europe. Huge numbers of companies that are spawned by companies that have gone public. So to close here, the last comment is that temporary insanity in 2021 is coming back home to roost. I mean, that's a very, very positive commentary. Vintages in and just after economic downturns are a good time to put money to work. Pre-seed affords the best opportunity of that. There's opportunities internationally, and so if you believe in the long-term growth and opportunity in technology sector, investing diversified on a global basis in early stage venture makes a heck of a lot of sense. Okay, sorry.
Thanks, Todd. My name's Rich Sobel. I've been with 361 from the early days. I know Mark going back to our time together in Russia. I guess I wear a couple of hats. I run a single-family office, and I also am an investor, venture partner in a blockchain fund, and I've incubated an early-stage fund together with Eddie Vanderpart in Impact. And I agree with some of the comments that were said earlier by the venture panel. Basically, when you're investing as a single-family office or a venture investor, you really have to know yourself, know what your goals are, to be able to establish the right investment policy, investment strategy. So what I say now is mostly my personal views about how we go about doing asset allocation and venture selection. Basically, I've enjoyed in my career being an early pioneer investor in emerging markets private equity, backing entrepreneurs, helping build businesses. I did that in the 90s and I did that in the 2000s. And the first time around it was very successful, and the second time not so. And the macro environment was highly disruptive. So you could say I had a master class in managing risk. One of the lessons that I learned is oftentimes you don't realize exactly how much risk you're taking. And I think that that's an important lesson when you look at allocating to direct deals or to managers. So one thing I'd say is early stage is great, but it's not a tourist activity. You really have to know the risk you're taking, and you have to do it on a systematic scale basis. Choosing a few funds in early stage or choosing a few deals is high risk. If you do enough of them and you're in it enough, I think you can do extremely well. In fact, a friend of mine from Stanford who set up Proof Capital is an early stage venture guy. He figured out that it's mostly the early stage guys who discover the future unicorns. And it's mostly the early stage guys who eventually run out of money. So what you want to do is have relationships with early stage guys and be able to participate as their winners emerge in co-investments. So we, in the single family office, were an early investor in Proof Capital. So we see a lot of co-investment, Fund 2, Fund 3. Most of what we do in the single family office is kind of lower risk stuff. But we did establish a basket for alternatives. And I think you could say it borrows from the endowment model. We've probably got about a third of the capital in private funds and private deals. Some of it was established managers, and some of it was emerging managers on Fund 2 or Fund 3. These are sub-$300 million managers, where our ticket size would be meaningful, where they demonstrated domain expertise and sourcing, ability to add value, and where we saw the opportunity to have co-investment. And that's worked out very well. We also, in partnership with Eddie, invested in about a dozen early stage venture deals. We've had 2 successful exits and no failures, but there are some companies that are challenged, and it is a very tough time to raise private capital for early companies, especially pre-revenue. I took a big sigh of relief last night when we signed a strategic deal with a partner coming into one of our companies. These things are tough. So, what am I excited about? I'm excited about the United States. Having spent 20 years in emerging markets, I love emerging markets. I believe in them. But I think you really have to be in them to be able to play them. Doing it remotely is not really a tourist activity. So most of our activities are domestic. I think private credit is a great place to be these days. And I still believe deeply in the entrepreneurial skills and resilience of folks in the United States to build viable, scalable businesses. And I love being part of that process, helping to provide capital and other skills and support. And by no means are we the best at this. So we have humility in understanding that by working alongside early stage and middle stage venture groups, we can leverage their expertise and we can be helpful where we can, but we know we've got some adults in the room. If there's something that goes wrong, we're not the only party that they're looking to for more capital. And if they need more capital, those other parties are there as a sign of validation. I would just say, in a closing, we are in an unprecedented period in terms of uncertainty and risk. But you could say that about the last 10 years, including COVID and financial crises and geopolitics. And I personally believe this is going to turn out to be a great vintage for people who can put capital to work effectively, and I'm excited about the future.
Thanks, Richard. I'm Neetu, and I lead VC allocation for Cooper Family Office. So we primarily are looking to invest in both venture capital and growth equity funds. I think for us, something that's important is diversification. So we're diversified across all asset classes pretty much. We have a huge public equities portfolio. We're looking at private credit in a tax efficient way. We have some private equity as well. And I think because of that, we are able to take some what might be considered risky bets in the venture industry. I think if you are going to make risky decisions, venture is this place to do that, especially if you understand what it's like to be a direct investor, which is my prior experience. I think with regards to emerging, to touch on some of the things Richard mentioned and Todd mentioned as well, emerging markets is definitely interesting, but I think emerging markets can also be within the US. There are whole other regions besides Boston, New York, and California. And I'm from Palo Alto, so I'm not just saying that, but we've been looking into a lot of different funds and deals in Idaho, North Carolina, the Midwest, and South, and the valuations have been about 1/5 or 1/4 of the valuations we're seeing in New York and Silicon Valley. So that's one point. Another point in terms of two areas where we're very, very bullish on is Israel and India. I think in particular, we think there's a lot of opportunity in both regions. Obviously, there is some geopolitical risk, but we're confident within the next 2 to 3 years we'll be able to still see good returns. To go off of what Richard said, it's really important to us that we partner with managers that have experience in both of those areas on the ground. So we're not really looking for people that are GPs based here and just solely making investments there. Would be looking for people based in in Tel Aviv or New Delhi or Bangalore respectively. And in terms of what I'm most excited by in the industry, I'd say early stage right now, and I think from pre-seed to Series A, and even Series B is at a really interesting inflection point. I think the pre-IPO markets, it's a really challenging time, but if there are GPs that have guided companies through M&A transactions, I think, it's a really interesting space. And I think venture secondaries is something that we have found really interesting and compelling. We've been tracking the secondary space and looking at both large and small funds. And yeah, we're really excited by what we see. Something else unique about us is we do take bets on emerging fund managers. That does include Fund 1, and we have actively allocated into Fund 1s even in the down market. It can be really challenging, of course, to de-risk Fund 1s, and something that we have done in that case is to look at both quantitative and qualitative characteristics of these GPs. That's not just looking at the GP performance, but also looking head-to-head when comparing SaaS funds or AI funds or fintech funds, what makes this particular GP team unique and gives them that competitive advantage to be really investing in that particular sector and asset class. So we do look at head-to-head competition, and then we also look at what drives a lot of these GPs. I think a lot of the most successful GPs are spinning out of larger funds. They might be repeat entrepreneurs themselves. They have experience being on boards. They have experience hiring and firing. And for us, we believe there's a lot of alpha in finding these smart people early in their solo, GP career, early when they're doing their spin-off funds and backing them. And I feel like as allocators, if you back GPs in challenging fundraising markets and you believe and trust in them now, it's a great time to build relationships. I actually agree wholeheartedly with what Richard said about this year and 2024 being a positive, good vintage. I think if you look at the last recession, global financial crisis, a lot of really great unicorns came out of that. Airbnb, Uber are just two of them. And I think we're going to see a lot of unicorns and a lot of strong emerging managers coming out of this down market as well.
Thank you. I was asked to moderate, but we won't have time to moderate too much because we have a limited duration here. So I'll say a few words about myself. I'm David Tedden. I'm with Coolwater Capital. We are a GP stakes investor and backer of emerging VC funds. We run an accelerator for VC funds. People in the industry call us the Y Combinator for emerging VCs. We have graduated over 185 VC funds, which collectively have raised $2 billion. We typically take a position as an LP and sometimes as a GP and sometimes in the management company, the fund, depending on the exact dynamics of it. So I very much resonate with what you were saying about the international opportunity. You got to be on the ground, and you're seeing, just as you're seeing this evolution of unicorns around the world, you're seeing the next step, the evolution of VC funds, right? Founded sometimes by those people who worked for Rappi or whatever, right? And those people need support. The typical founder of a VC firm was a tech executive. Maybe they're a VC, but they didn't run a VC, which is a business in itself. So we focus on increasing their odds of success. The prompt that Mark gave was what is most exciting and what is most worrying. So for me, the answer is the same thing, which is productivity. Why do I say that? So if you look up technology, what is the definition of technology? Anything that enhances human productivity, right, that allows you to do more. So here's what's exciting, right? Financial markets go up and down, but what one human can do with technology just goes up and up, right? That curve keeps going. So, for example, I'm doing a deal now in a company with 2 full-time staff, 21 private equity clients. They use generative AI to do deal sourcing for private equity funds, and they're profitable, right? So it's hard to imagine in a prior era that you could build a company with that caliber of clients, profitable, recurring revenues, 21 clients with 2 people. And it's because they're very aggressive about using technology throughout the operation. And so I see tremendous opportunity by leveraging these new technologies. And if you think of the map, one of our earlier panelists said she's not sure what the emerging markets investors or entrepreneurs bring to the U.S. Well, I'd say in many ways, certain emerging markets are ahead of the U.S., right? So South Korea is ahead of the U.S. in high-speed internet being broadly available in mobile, right? There's a reason Mark Zuckerberg is learning Chinese, not just his wife, right? He wants to learn from the Chinese technology development, bring to the U.S. So we're seeing this layering of people taking lessons from different markets and bringing them here, and of course, vice versa. Now, why is this worrying? Well, it's worrying because it creates all sorts of instability, right? 9/11 was done by, I think, 20 hijackers, right? A small group of people can cause even more damage by using technology in all sorts of nefarious ways. It obviously creates potential political risk as more people worry about their jobs. Not currently an issue because unemployment, of course, is so low, as our earlier speaker referenced, but long-term, that is certainly a concern. The number one job in, I think, 12 states is truck driver, right? I'm not sure those jobs are going to exist 10 years from now. So the fact that human productivity keeps increasing creates tremendous opportunities for VCs, but also creates an opportunity for malefactors and for instability. Last thing I'll say that's exciting for me is if you look in the public markets, there's a multi-decade trend towards use of greater data analytics. If you look internally at D. Shaw, Two Sigma, firms like that, they look like software companies. They don't look like Charlie Munger using a pencil going through 10K, which worked out fine for him, with due respect, right? But in the private markets, we're way behind, right? Many private equity VC funds, their tech stack is Excel and Salesforce.com. So I think the next generation of emerging managers are going to be much more aggressive about the use of technology and analytics. I run a blog, teton.com, about emerging managers, and that's a focus. How do you find the right tools to increase your returns? And so there's a lot of opportunity to do better through use of technology and analytics.
We have 1 minute more.
And I did not do it the last panel, and a big mistake. We always have questions from the crowd.
Okay.
So I think before we break, we want to hear. You've heard this is really a venture panel, not an asset class panel, but fine. If you don't mind, just what are the questions for this group? I'm shy.
So what should we do now? Invest in early stage venture.
If you're not, well, let me ask the question. Are you actively invested in the venture capital space?
Yes.
Okay, and are you active with that, or are you passively investing in a bunch of different things, or actively investing in individual companies?
So it's a hybrid, but...
Okay, so if you want to get some allocation to international, find a manager that has a globally diversified portfolio of early stage companies. That's one thing I would do.
I have an amazing space company he can invest
Thank you.
in.
No. Any other questions?
What are some of the technologies you're seeing that these new emerging VCs are using? What's some of the tech that you're referring to? Some of these new managers.
So for those interested, I have a 10,000-word answer, but I will not give that to you here. So briefly, there's a lot of use of generative AI for deal sourcing. The company I mentioned earlier, the way it works is you say to them, I'm interested in, say, semiconductor companies in the Midwest, right? So create a list of such companies and send them an email saying, hi, I'm interested in potentially investing in your company, but they don't sound canned, right? What they're doing is they're mapping the bio of the target, right? What awards has she received? Has her firm recently hit a big milestone? And the sender, and then they're saying, oh, you went to the same school as me, congratulations on the award you just got. That's the work an analyst would do historically. Now you just do it with generative AI. Another huge opportunity is data scraping, right? There's more and more data exhaust out there that you can scrape in order to find out what are the fast-growing companies, whose headcount has grown, who has signed new leases, right? Those are all proxies for growth that indicate you might want to reach out.
What's everyone's view on
you go.
venture debt?
What's the view on venture debt at the moment?
Given the issues in the marketplace, there's a lot more need for it, but it's bloody expensive.
Yeah, I will add Silicon Valley Bank. I love them. Right, they basically were from according to a lot of the CFOs I work with. Right, they were selling it at a loss. Right, in order to get the long-term business. Right, so they were they're going away. It raised prices for the whole industry, which is good from the point of view of the venture debt lenders.
Anyone else? Go ahead, Jason.
I guess I could speak loudly. Can people hear? Actually, two questions. One question is that most, around 1,000 VC funds in the U.S. alone, we all know that most of them underperform. And there's such I've been in Silicon Valley for 50 years, right? There's nothing I haven't seen. And there's such an overhype when it comes to AI investments, AI this, AI that. What are some of the real roadmaps, executable strategic roadmaps that you really recommend to both potential investors into your fund and those single-family offices that like to still do things more directly into the companies?
I mean, there's a joke when you ask GPs about performance that every GP says they're part of a top quartile fund. I think something that's like, we're looking at deep tech and we're interested in AI, but I think a lot of funds are just claiming to be AI funds when they're not. So I think the hype does make it difficult to diligence. Something that we've been taking into account is we're still looking at generalist and sector-specific funds both, but we're looking at AI in the infrastructure and application layer. Personally, more than large language models, we feel like that has a little bit of a longer lasting potential, and we feel like we would be able to diligence that better. I think also when looking at GPs that say they're doing AI, asking them how they're diligencing the technical teams and how they're diligencing the technical stack is something that we really dig into. We also try to understand what are the differentiators and the moats, in terms of proprietary data engines, and then also just looking at their background. If there's two people who just have humanities degrees, no STEM, no experience in building, and look, I'm a humanities person, so I'm not knocking on it, and they say that they're doing a deep tech fund and they don't have any experts in the space, that's a red flag for us. So I think just making sure we have that quant focus. And then also, a lot of funds are already investing in AI technologies. They don't need to label themselves an AI fund. So I think when there's a fund that says that they're an AI fund and that they just cropped up in the last year or two, I really try to dig into the investment thesis to be are they, taking advantage of the hype cycle? Were they a Web3 fund 2-3 years ago? I think I sat in on YC's demo day and I noticed that a lot of the companies were just tacking on the words ML, AI onto their decks just to drive up valuations. And I think if there are investors that are unfamiliar with VC, they'll kind of follow the hype and the trends. And I've been looking at AI as a researcher since I was at Oxford in 2017. So beyond hype cycles is the way we look at things at Cooper.
All right, we have to continue discussions in the wine room, the dining room, and I don't know what Jim means by
I don't know which room you picked for the other two
rooms. But these are, of the two panels, we've got the public markets. I did promise Marshall Presti and John Duran that they could have the wine room to continue their discussion. I don't know what you mean by the dining room.
This is the dining room.
This is the ballroom.
Okay.
But actually, the dining room would be where the private equity, before we had dinner last night, it's the chef's kitchen room, which is back here. So let's say right next to the wine room. Dining/ballroom here, venture. And if you're interested in emerging markets or anything outside the U.S., look at Oleg. Oleg created the Netflix of Russia, right? I'm looking around and we have such an interesting, eclectic, international gathering. So if you're interested in something, emerging markets or just Latin America, Africa, I hate to do it, but I guess you take the area outside where it's really loud So those are the four. But what do we do? And I'm going to go find someone who's going to help moderate and report on the takeaways. The most important thing is that everybody introduces themselves. How many conferences do you get to go to do that? This is what we're about because of our alumni history. So once you settle in 5 minutes, move around, and we'll be encouraging you to move around. Mingle, introductions. These are very short introductions. You're not a panelist. You're just introducing yourself, where you are, what you do. And then, I think we won't have any necessarily. If somebody wants to do Q&A on insights, but the main thing is talk about those asset classes, and then think about what do we want to do as a community to go deeper. You heard Ken Goldman and Colia talked earlier today about your proof capital. But we need to, that was like a 5-10 minute thing. Todd, I had to cut him off. We should be able to do deep dives on all these subjects, and we can, because that's what we do. And then we come back, let's do debriefs here, and we're going to then go to one more emerging and re-emerging industries, and then impact, philanthropy, next gen, and then one more set of breakouts, but except this time you'll have wine in your hand, which might be a different factor. And then we come back and we have a reception. So for now, go to those rooms based upon your interests. And we'll see you back here in about half an hour.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.